Welcome to TradeTheMBI.com. This is John. This report is for the 30th of August, and I kind of highlighted right here on our daily chart the crossover on the MBI of the magenta over yellow, which spawned this latest move towards the highs, as well as right here on the DOC that even after we had the orange dip, which corresponded to that crossover literally just a day later, but proving its power when the green moves above cyan in this continued run, suggesting that there was going to be no change in that push. Now, we knew that within that, yes, we would get slight moves back to the ABM in that, but every time we did, supported off that yellow line right there, popped right back up to the highs, which is what we saw happen on Friday, and all very consistent. Some people will still tout overbought, this and that, but when we look at our shakeout indicator, we realize, no, we're not anywhere close to that. Now, we're making so far a lower shakeout histogram on higher highs, but it's still rising, so it has the potential for overtaking that. And as long as we're consistent with that, there's nothing abnormal about what we're seeing within the market. And of course, this ties into the Fed's actions, and they're saying that they're going to continue to provide low-cost money and no change in rates, which means money is forced into capital markets. There's just no other way around it. It's a simple economic premise. It's like people are going to go to where they can get yield, and this is the only place that you can get it at this particular point, and that continues to drive asset prices higher. Now, is that a bubble? Well, sure. Will it end at some point? But something I've been preaching for since day one of Trade the MBI, you never fight the Fed. They have unlimited resources and unlimited capability, and as long as that's their intention, you've got to go with it. Now, as soon as that starts to shift, and you'll recognize it because inflation and those kind of things will force their hand, and that will be catastrophic given the debt levels that you have in that and the pressure that that would put on budgets as well as taxes, and that will have extraordinary counter balancing effect sometime in the future. It's just a matter of us waiting for that to take place, and it will happen. But until it does, we just keep going with what we can see from the readings. And you look at the NASDAQ, likewise, never even broke back below the on the DOC here, the green below cyan. So shorts aren't really activated in this, nor is there much selling going on from that standpoint, and that keeps driving it forward. The difference is that it gets more difficult on the push to the upside when you don't have shorts adding into the setup, because that often in the past has driven price higher because of short covering. So, this is that interplay that always moves price. At a certain point, though, economic activity has to support that overall viewpoint, and that really becomes the question mark. Right now, the market really isn't concerned with that, given the fact that asset prices are just a result of needing to have some type of return that you're not able to get in normal capital markets simply because of government action. And so you just have to go with that until that tide changes. And it will. Will it be sudden? Probably not, unless there's a major policy Fed change or some kind of economic situation that results in it. And the downside factor that we look for on that is clearly inflation. As long as it remains at a point where it's not forcing the hand of the Fed, everything's going to be fine. And the easiest way to do that is to limit economic growth. The reality is that the actions of individual, states in this case, where it comes to pandemic controls, things like that, are really limiting that pressure. And like I've always said, you feel that with keeping energy prices reasonable, as well as flooding the marketplace with cheap and expensive labor, and you can really sustain this for a period of time, even with elevated inflation at its core levels. You'd be able to get away with it and help underwrite it, but at that point you still have to get your deficits under control, and that's not happening. And so this is where really there's a higher degree of uncertainty, but within that you have the fear melt-up of everyone afraid that they're going to miss something. And that's why you're going to see gold continue to rise too, because there's always going to be those that want to hedge against what they see coming down the road. And whether it's this year, next year, or sometime in between, the more people that move towards those defensive positions, the more capital that will get put on the sidelines in speculative things. This is why also we follow currency changes, as well as, in our particular case, the new cryptocurrencies. And you see why they have their effects, because they become a hedge plays. And is that gambling or some other form? Not necessarily, no more than the speculative nature being investing in stocks and that. But within that reality, we can still play them, and the algorithms still work according to that behavior. And so, like even Bitcoin here, we had that 47,000 buy signal, moved us up to the 50s, and then of course we had that weakness develop right there, pull back to the 50%, and now you start to get behaviors that are more related to what institutional setups. And when you get that kind of normalization from like this in Bitcoin that we've been seeing over the last year or so, as things start to correlate more with bigger player activity, it becomes more consistent. And that was always the need for the cryptocurrency markets, was to develop more normalcy. And so when you had the bigger investment firms moving into these spaces, you should see that order as they get involved in it. From an intraday standpoint, 5K, we had the buys, it went all the way up. And every little sell signal we had turned around pretty darn quick with the magenta rising above. And that just kept fueling it in between. Didn't create that many positive extremes. All the ones that were generated pretty much got filled back in place. So pretty clean action from this standpoint. We had a couple individual, if you look at them right here from the extreme histogram, little red histogram lines. Each of those that popped in were filled, and even post-market, same situation. So everything's looking pretty congruent. As always, though, I'll keep updating anything relevant, and we'll continue to follow the market as it is. Indicators for September will be coming out and all set to go for the next month, which as many of the bigger players come back in there, I think we'll probably see that volatility start to ramp up on both sides. I mean, I still think the volatility is strong when we have this kind of big move to the upside. That's still volatile relative to some of the smaller ranges that we've seen. So all in all, 4,500 on the S&P, still have a somewhere around 4,650 or so would be an area that I would look at. But of course, intraday from that standpoint, 45-20 range probably would be an interesting place to see if we get some type of pullback. And any of those are really natural occurrences that you really want, because when things get parabolic outside of the normal range, then there's always that mean reversion, and that is the nature of the broader indexes, and that's why they're so important to follow. As always, though, I will update the Skype chat and continue to put up charts. Trade well, and we'll talk again later.